When Donald Trump entered the White House in January 2017, the United States economy was already deep into a long recovery from the 2008 financial crisis. Growth had stabilized, unemployment was steadily declining, inflation remained low, and financial markets were near historic highs. Yet beneath these positive indicators lay widespread dissatisfaction. Many Americans felt left behind by globalization, automation, and stagnant wages, especially in manufacturing-heavy regions that had once powered the U.S. economy. For nearly a decade, economic policy had focused on stabilization rather than transformation. The Federal Reserve played a dominant role through ultra-low interest rates and quantitative easing, while fiscal policy remained relatively cautious. Corporate profits recovered strongly, but income inequality widened. Productivity growth slowed, and labor force participation failed to return to pre-crisis levels. These imbalances created fertile ground for a political outsider promising disruption. Trump's economic message was simple, direct, and emotionally charged. He argued that America's economy was being cheated by unfair trade deals, exploited by foreign competitors, and constrained by excessive regulation. Manufacturing job losses were framed not as structural change, but as the result of bad leadership and weak negotiation. This narrative resonated deeply with voters who felt disconnected from Wall Street's success. Globalization had reshaped the U.S. economy over decades. Supply chains stretched across continents, and trade agreements such as NAFTA symbolized economic integration. While these arrangements lowered consumer prices and boosted corporate efficiency, they also intensified competition, putting pressure on domestic industries and workers. Trump promised to reverse this trajectory, bringing jobs back through protectionism, tax cuts, and deregulation. Politically, the stage was set for a radical shift. Trump rejected traditional Republican economic orthodoxy in some areas while embracing it strongly in others. He supported massive tax cuts for businesses, but also favored tariffs long viewed by economists as harmful. This blend of populism and pro-business policy would define his economic agenda. The economy Trump inherited was not collapsing, but it was deeply divided. Strong headline numbers masked structural frustrations. Understanding this context is essential because Trump's policies were not designed merely to stimulate growth. They were aimed at reshaping the economic narrative itself, redefining winners and losers in a globalized world. Donald Trump's economic philosophy was built around a single, powerful slogan, America First. While simple on the surface, this idea represented a sharp break from decades of U.S. economic thinking. Previous administrations, both Republican and Democrat, had largely embraced globalization, free trade, and multilateral cooperation as engines of growth. Trump rejected this consensus, arguing that these policies benefited elites and foreign competitors at the expense of American workers and industries. At the heart of Trump's approach was economic nationalism. He viewed the global economy as a competitive battlefield where nations either win or lose. Trade deficits, in his view, were proof that the United States was losing. This perspective challenged mainstream economics, which treats trade deficits as a complex outcome of savings, investment, and currency flows rather than a simple scorecard. For Trump, however, the symbolism mattered more than theory. Reducing deficits became a political and economic priority. Trump also emphasized bilateral deals over multilateral agreements. He argued that large trade frameworks diluted American power and constrained negotiation leverage. By dealing directly with individual countries, the U.S. could, in his view, extract better terms. This belief shaped decisions to withdraw from or renegotiate major agreements and place tariffs at the center of economic strategy. Tariffs were not just economic tools, they were bargaining weapons. Another key pillar of Trump's philosophy was deregulation. He argued that excessive rules had suffocated innovation, discouraged investment, and slowed growth. by rolling back regulations especially in energy, finance, and environmental policy. Trump aimed to unleash business activity. This approach aligned with traditional pro-business Republican thinking, even as his trade policies departed from it. Trump's economic vision also redefined the role of government. While advocating lower taxes and fewer regulations, he was willing to use state power aggressively to influence markets, pressuring companies to keep factories in the U.S., publicly criticizing firms that moved operations abroad, and intervening in trade disputes, all reflected a hands-on approach. This blurred the line between free market principles and state-directed economic behavior. Critics argued that Trump's philosophy underestimated the complexity of global supply chains and risked retaliation from trading partners. Supporters countered that disruption was necessary to correct decades of imbalance. What was clear, however, was that Trump's economic agenda was driven as much by political identity as by policy outcomes. It aimed to restore a sense of control and pride, not just improve economic indicators. America First reshaped expectations of what U.S. economic policy could look like. It prioritized sovereignty over integration, leverage over cooperation, and visible action over long-term consensus. Whether this approach strengthened or weakened the economy would become one of the most debated questions of Trump's presidency. In late 2017, Donald Trump delivered the centerpiece of his domestic economic agenda, the Tax Cuts and Jobs Act. It was the most sweeping overhaul of the U.S. tax system in decades and a defining moment of his presidency. Supporters hailed it as a bold pro-growth reform that would unleash investment, raise wages, and restore American competitiveness. Critics warned it would explode deficits, deepen inequality, and primarily benefit corporations and the wealthy. The most dramatic change was the reduction of the corporate tax rate from 35% to 21%. For years, U.S. corporations had argued that the high rate discouraged domestic investment and pushed profits overseas. Trump's administration framed the cut as essential to bringing capital back home and making American businesses globally competitive. In theory, lower taxes would free up cash for expansion, innovation, and job creation. The law also introduced a shift toward a more territorial tax system, allowing companies to repatriate foreign earnings at lower rates. Trillions of dollars held abroad suddenly became accessible. Supporters expected this to translate into a wave of domestic investment. In reality, much of the repatriated money went towards stock buybacks and dividends rather than large-scale capital spending. Shareholders benefited quickly, while broader wage growth remained limited. For individuals, the tax law reduced rates across several income brackets and nearly doubled the standard deduction. Many middle-class taxpayers saw modest short-term gains, but the benefits were uneven and in some cases temporary. Several individual tax cuts were set to expire after 2025, while corporate cuts were permanent. This asymmetry fueled criticism that the law favored businesses over households. The fiscal consequences were immediate. Federal revenue declined, and budget deficits expanded significantly, even before the economic shock of the COVID-19 pandemic. Trump argued that faster growth would offset lost revenue, but economic expansion remained within historical norms. The tax cuts added to long-term debt concerns, especially as the administration simultaneously increased spending. The Tax Cuts and Jobs Act also reshaped political debates around taxation. It reinforced the idea that competitiveness required lower corporate taxes, influencing future policy discussions. Yet it also intensified concerns about inequality and fiscal sustainability. The law became a symbol of Trump's broader economic approach, aggressive, business-friendly, and unapologetically tilted toward growth through incentives rather than redistribution. Whether the tax cuts achieved their stated goals remains contested. What is clear is that they transformed the structure of U.S. taxation, shifted the balance of benefits, and left a lasting imprint on the economy. As the cornerstone of Trump-era economics, the Tax Cuts and Jobs Act set the stage for both the gains and the vulnerabilities that would follow. Trade policy became the most visible and controversial element of Trump-era economics. Breaking sharply with decades of free trade consensus, the administration embraced tariffs as a central tool to protect domestic industries and pressure foreign governments. Trump argued that unfair trade practices, especially by China, had hollowed out American manufacturing and weakened national security. Tariffs, in his view, were not a last resort, they were a strategy. The administration imposed tariffs on steel and aluminum imports, citing national security concerns. These measures aimed to revive domestic production and reduce dependence on foreign suppliers. While some U.S. producers benefited from higher prices, downstream industries faced rising costs. Manufacturers that relied on imported inputs struggled, revealing the complexity of modern supply chains where protection in one sector can harm another. The most significant confrontation was with China. Tariffs were placed on hundreds of billions of dollars worth of Chinese goods, triggering retaliation against U.S. exports. The conflict went beyond trade balances. It was about technology, intellectual property, and global leadership. American farmers were hit hard as China targeted agricultural exports, forcing the U.S. government to provide large subsidies to offset losses. Trump's trade war also extended to traditional allies. The renegotiation of NAFTA resulted in the United States-Mexico-Canada Agreement, USMCA, which included updated labor and environmental standards. While less disruptive than initially feared, the process introduced uncertainty that affected investment decisions. Businesses delayed expansion amid unclear trade rules. Supporters of tariffs argued they forced long overdue conversations about trade imbalances and industrial policy. Critics countered that tariffs functioned as a tax on consumers, raising prices without delivering long-term job gains. Studies showed limited reshoring of manufacturing and significant costs to households and exporters. Trade wars reshaped global commerce by accelerating supply chain diversification. Companies sought alternatives to China, moving production to other countries rather than returning it to the U.S. This reduced reliance on a single supplier, but did not fully achieve Trump's goal of domestic revival. Trump's trade policies challenged assumptions about globalization and reasserted the power of the state in shaping trade. Whether viewed as necessary correction or costly disruption, they marked a turning point. The global trading system emerged more fragmented, more uncertain, and less anchored to the principles that had defined it for decades. Deregulation formed a central pillar of Trump's economic strategy. From the start of his presidency, Trump promised to roll back what he described as excessive regulations that burdened businesses and stifled growth. The administration framed regulation not as protection, but as an obstacle to innovation, investment, and job creation. This philosophy shaped policies across multiple sectors, with the most dramatic changes occurring in energy, environmental oversight, and finance. The energy sector became a showcase for Trump's deregulation agenda. Restrictions on oil, gas, and coal production were eased. Federal lands were open for drilling, and environmental rules were relaxed. Trump promoted energy dominance as both an economic and strategic goal, arguing that abundant domestic energy would lower costs, create jobs, and reduce reliance on foreign suppliers. In the short term, these policies supported increased production and strengthened the U.S. position as a leading energy producer. However, the benefits came with trade-offs. Environmental protections designed to limit pollution and address climate change were weakened or reversed. Critics warned that rolling back regulations increased health risks, environmental damage, and long-term economic costs. The administration dismissed these concerns, prioritizing immediate economic gains and industry competitiveness over environmental sustainability. Financial deregulation also accelerated. Rules implemented after the 2008 financial crisis were softened, particularly for mid-sized banks. Supporters argued that these changes freed smaller institutions from compliance burdens, enabling them to lend more and support local economies. Critics feared that weakening safeguards increased systemic risk and encouraged risky behavior, reminiscent of pre-crisis conditions. Beyond specific sectors, deregulation signaled a broader shift in government philosophy. Federal agencies were directed to reduce regulatory costs and eliminate existing rules for every new regulation introduced. This approach aimed to institutionalize deregulation as a permanent feature of governance rather than a temporary policy choice. The economic impact of deregulation was mixed. While some industries experienced reduced costs and increased activity, the broader gains were difficult to measure. Growth remained steady, but not dramatically higher than pre-Trump trends. Meanwhile, long-term risks, environmental, financial, and social, became harder to ignore. Deregulation under Trump highlighted a fundamental tension in economic policymaking, the balance between growth and protection. The administration prioritized speed, competitiveness, and visibility of results, often at the expense of precaution. Whether these choices strengthened the economy or shifted costs into the future remains a central question in assessing Trump-era economic policy. One of the strongest claims of Trump-era economic policy was that it would revive the American worker. Rising employment, higher wages, and renewed manufacturing strength were presented as proof that America First economics was delivering tangible results. During the early years of Trump's presidency, headline labor market indicators appeared to support this narrative. Unemployment fell to historically low levels, job openings increased, and labor markets tightened across much of the country. Much of this momentum, however, reflected trends already underway before Trump took office. The U.S. economy had been steadily adding jobs for years, and unemployment had been declining since the aftermath of the 2008 financial crisis. Trump's supporters argued that tax cuts, deregulation, and business-friendly rhetoric accelerated these gains by boosting confidence and investment. Critics countered that the improvements were largely a continuation of the existing expansion, rather than a dramatic policy-driven shift. Wage growth did show signs of improvement, particularly for lower-income workers. Tight labor markets forced employers to raise pay and offer better conditions to attract workers. Minimum wage increases at the state and local level also contributed to rising earnings, independent of federal policy. For a time, income gains at the bottom outpaced those at the top, slightly narrowing wage inequality. This trend was often cited as evidence that Trump's economic approach benefited ordinary Americans. Yet deeper structural issues remained unresolved. Labor force participation among prime-age workers improved, but did not fully recover to pre-crisis levels. Automation and technological change continued to reshape jobs, especially in manufacturing. While some factories reopened or expanded, overall manufacturing employment growth was modest, and many jobs created were vulnerable to global competition and future downturns. Inequality remained a defining feature of the Trump-era economy. The tax cuts disproportionately benefited higher-income households and capital owners, reinforcing wealth concentration. Stock market gains boosted asset values for those already invested, while many households lacked meaningful exposure to financial markets. Regional disparities persisted, with urban centers and technology hubs outperforming rural and industrial regions. The COVID-19 pandemic would later expose these vulnerabilities in dramatic fashion, wiping out millions of jobs and reversing labor market gains almost overnight. While the crisis was not caused by Trump-era policies, it highlighted the fragility of progress built on long expansions without deeper structural reform. Labor market performance under Trump reflected both strength and limitation. The economy delivered low unemployment and modest wage gains, but it did not fundamentally alter the forces driving inequality and insecurity. The promise of broad-based prosperity remained only partially fulfilled, leaving unresolved questions about the long-term impact of Trump's economic vision. Immigration policy played a significant but often overlooked role in shaping the Trump-era economy. While framed primarily as a national security and cultural issue, immigration also had direct economic implications for labor markets, supply chains, and business planning. Trump's administration pursued a restrictive approach, arguing that limiting immigration would protect American jobs and raise wages. The economic consequences of this shift were complex and uneven. Tighter immigration controls reduced the inflow of both low-skilled and high-skilled workers. Industries such as agriculture, construction, hospitality, and healthcare sectors, heavily dependent on immigrant labor, faced worker shortages. Employers reported difficulties filling positions, even as unemployment remained low. In some cases, wages rose as firms competed for scarce labor, but higher costs were often passed on to consumers, increasing prices and reducing competitiveness. High-skilled immigration was also affected. Policies restricting work visas and increasing scrutiny created uncertainty for technology firms and research institutions. Critics warned that limiting access to global talent undermined innovation and long-term growth. Supporters argued that American workers would benefit from reduced competition. The debate highlighted tensions between short-term labor protection and long-term productivity. Supply chains became another area of strain. Combined with trade wars, immigration restrictions added friction to global production networks. Businesses faced rising costs, delays, and uncertainty. Planning long-term investments became more difficult as policy direction appeared unpredictable. While some firms adjusted by diversifying suppliers or automating processes, others postponed expansion or shifted operations abroad. Business confidence responded strongly to Trump's rhetoric and actions. Tax cuts and deregulation boosted optimism, while trade tensions and immigration uncertainty dampened it. Surveys showed fluctuating expectations, reflecting the mixed signals sent by the administration. Companies benefited from pro-business policies, but struggled with instability in trade and labor rules. The broader economic impact of immigration policy was difficult to isolate, but its effects were real. Labor shortages constrained output in key sectors, while uncertainty reduced efficiency. The administration prioritized visible enforcement and symbolic action, often at the expense of nuanced economic outcomes. Trump's approach to immigration underscored the interconnectedness of modern economies. Labor, trade, and supply chains operate across borders, and disruptions in one area ripple through others. While the policies aimed to assert control and protect domestic workers, they also revealed the costs of isolation in a globalized economic system. The COVID-19 pandemic marked the most dramatic economic shock of the Trump presidency, abruptly ending one of the longest economic expansions in U.S. history. Within weeks, businesses shut down, supply chains fractured, and tens of millions of Americans lost their jobs. The crisis was unlike anything policymakers had faced in generations, forcing the Trump administration to abandon traditional economic priorities and embrace massive government intervention. In early 2020, financial markets plunged as uncertainty spread. Entire sectors, travel, hospitality, retail, and entertainment, collapsed almost overnight. The labor market experienced a shock of historic magnitude, with unemployment soaring at record speed. The sudden halt to economic activity exposed vulnerabilities that years of growth had masked, including fragile household finances and deep inequality. The administration responded with unprecedented fiscal stimulus. Congress passed the CARES Act, injecting trillions of dollars into the economy through direct payments to households, expanded unemployment benefits, and loans to businesses. These measures reflected a dramatic shift from Trump's earlier emphasis on small government and fiscal restraint. In crisis mode, ideology gave way to necessity. The Federal Reserve also acted aggressively, cutting interest rates to near zero and launching massive asset purchase programs. Coordination between fiscal and monetary authorities helped stabilize financial markets and prevent a complete collapse. Stock markets recovered quickly, even as the real economy continued to struggle, a divergence that reignited debates about inequality and financialization. Emergency economics came at a cost. Federal debt surged to levels unseen since World War II. Trump defended the spending as essential, arguing that saving the economy outweighed long-term fiscal concerns. Critics warned that ballooning deficits would burden future generations and limit policy flexibility. Supporters countered that failure to act would have caused far greater damage. The pandemic response also revealed governance challenges. Implementation delays, uneven support, and political conflict undermined effectiveness. While stimulus prevented deeper collapse, it could not fully offset prolonged disruptions. Small businesses closed permanently, and labor market recovery proved uneven across income groups and industries. COVID-19 fundamentally altered the assessment of Trump-era economic policy. It showed that growth driven by tax cuts and deregulation could not insulate the economy from systemic shocks. The crisis reframed debates about the role of government, highlighting the importance of resilience, social safety nets, and crisis preparedness. The pandemic did not erase the impact of Trump's earlier policies, but it overshadowed them. Emergency measures became the defining economic story of his final year in office, leaving behind a transformed fiscal landscape and unresolved questions about sustainability. Trump-era economic policies did not operate in isolation. Because of the United States' central role in the global economy, shifts in American policy reverberated far beyond its borders. Allies, rivals, investors, and international institutions were forced to reassess long-standing assumptions about U.S. leadership, reliability, and economic strategy. The result was a period of global uncertainty that reshaped trade, finance, and geopolitics. Trade wars altered global supply chains. Tariffs imposed by the United States and the retaliatory measures that followed disrupted established production networks built over decades. Companies accelerated efforts to diversify suppliers, reducing dependence on China but not necessarily returning production to the U.S. Instead, manufacturing shifted toward Southeast Asia, Mexico, and other emerging markets. This reconfiguration signaled a move toward a more fragmented global economy. America's withdrawal from multilateral agreements and skepticism toward international institutions weakened its traditional leadership role. Allies questioned whether the U.S. would continue to support rules-based economic order. In response, other powers stepped in. China expanded its influence through trade initiatives and investment, while the European Union pursued greater strategic autonomy. The global system became more multipolar, with economic power increasingly distributed. Financial markets closely watched Trump's fiscal and trade policies. Large tax cuts combined with rising deficits raised concerns about long-term debt sustainability. Yet the dollar remained strong due to its status as the world's reserve currency. This paradox highlighted the unique position of the U.S., able to borrow cheaply despite growing imbalances. However, it also reinforced global dependence on American financial stability. Emerging markets faced particular challenges. Trade tensions slowed global growth, reduced investment flows, and increased volatility. Currency fluctuations and capital outflows exposed vulnerabilities in countries dependent on exports and foreign financing. Trump-era policies, while focused on domestic priorities, intensified pressures on already fragile economies. The pandemic further complicated America's global economic role. Massive U.S. stimulus supported global demand, but also contributed to financial distortions. Recovery diverged sharply between advanced and developing economies, deepening inequality at a global scale. The U.S. response influenced how quickly the world economy stabilized, underscoring its enduring influence. By the end of Trump's presidency, the global perception of U.S. economic leadership had changed. The country remained powerful, but its approach was seen as less predictable and less cooperative. This shift forced nations to adapt, diversify, and prepare for a world in which American policy could change abruptly. Trump-era economics marked the transition point. It challenged the assumption that globalization would continue uninterrupted under U.S. guidance. In doing so, it reshaped global expectations and left behind a more cautious, fragmented, and uncertain international economic environment. Trump-era economic policies represented one of the most disruptive shifts in U.S. economic strategy in decades. They challenged long-standing assumptions about free trade, globalization, fiscal discipline, and the role of government in markets. Whether viewed as bold correction or dangerous experiment, the economic legacy of Donald Trump cannot be dismissed as ordinary. It reshaped debate, priorities, and expectations in lasting ways. At their core, Trump's policies reflected deep skepticism toward global integration. Tariffs, trade wars, and renegotiated agreements signaled a move away from multilateral cooperation toward unilateral leverage. This approach resonated with voters who felt abandoned by globalization, yet it introduced uncertainty that weighed on investment and strained alliances. The promise of reshoring jobs proved harder to realize than anticipated, revealing the complexity of modern economies. Domestically, tax cuts and deregulation delivered short-term boosts to corporate profits and market confidence, but at the cost of higher deficits and persistent inequality. Growth continued, but largely in line with pre-existing trends. Structural challenges, productivity, workforce resilience, and income distribution remained unresolved. The benefits of policy changes were uneven, reinforcing divides between regions, sectors, and income groups. The COVID-19 pandemic redefined Trump-era economics. Emergency stimulus and massive government intervention contradicted earlier fiscal rhetoric, demonstrating that ideology yields to crisis. The response prevented economic collapse, but left behind record debt and a transformed policy landscape. It also underscored the importance of preparedness, social safety nets, and coordinated action. Globally, the Trump presidency marked a turning point. U.S. leadership became less predictable, accelerating shifts toward a more multipolar economic order. Nations adjusted by diversifying partnerships and reducing reliance on American policy stability. The world economy emerged more fragmented, with resilience and autonomy gaining importance over efficiency alone. The lasting lesson of Trump-era economics is that policy is inseparable from politics and identity. Economic decisions are not judged solely by metrics, but by who they serve and what they symbolize. Trump's approach prioritized visibility, confrontation, and national pride, redefining how economic success is framed. As future leaders confront inequality, technological change, and global uncertainty, the Trump era stands as a case study in disruption. It demonstrates both the appeal and the limits of economic nationalism. The debate it sparked about trade, government power, and global integration will continue to shape economic policy long after the presidency itself has ended.